Hello and welcome to this edition of the Wards Intelligence 6-Minute Webinars. I'm Hank Stoddard, Senior Industry Analyst Markets for Wards Intelligence, and today I'll be going over where we currently see the U.S. market going for the rest of the year in this COVID-19 environment. Right now we see demand on a seasonally adjusted basis rising gradually through the end of the year. Light vehicle sales in total are expected to number 13.3 million units in 2020. That means that the second half would run at a very weak 13.4 million seasonally adjusted annual rate. We do think there's more upside than downside to demand in the second half, although the recent upsurge of the virus, and especially in some highly populated states, is putting a little bit of a damper to that optimism. Looking at inventory, the graph here is showing days supply for light vehicles by month. 2020 is actual through June, and then our current projection through the end of the year is there. We're comparing that with the 5-month average 2015 to 2019 as a way to sort of see whether or not inventory looks like it's running above or below or just about right related to current and expected demand through the end of the year. Right now, low stock levels will put a limit on how high sales can go in the third quarter. Assuming there's no major production disruptions over the summer, though, inventory should be in line with rising demand by the end of the summer. In fact, if demand were to rise faster than what we expect it to do in the fourth quarter, manufacturers should have enough production capacity to raise inventory levels enough to meet that higher demand. Staying with inventory, some are worse than others, but all segment groups are well below their year-ago totals. Production stoppages in the spring left total inventory in May down 33% year over year, and inventory was still down 33% at the end of June. Looking at a couple of key segment groups, hefty market share in the second quarter drained pickup inventory, as you can clearly see on the chart on the left. Availability is best among CUVs, which is good in a way because CUVs are the best-selling segment in the market. It's especially true inside the CUV segment for mainstream and premium-priced small-size cross-utility vehicles, which had record market share of well over 11% in June, and that was mainly due to a high mix in that group of overseas-sourced vehicles. Looking at the sales side of segments, the top graph here is showing sales by month market share for segment groups, and the same thing for sales of imports or overseas sourced vehicles in the bottom chart. The disruption in the flow of overseas built vehicles was not nearly as bad as it was for their North American built versions. In fact, import penetration rose to 11-year any month highs in May and June. Solid import stock was behind the May-June surge in CUVs overall, and that surge should continue in market share at least through the third quarter. Incentives were especially effective in sales of pickups in the March to June period, but because of the inventory shortage that we saw on the previous chart, I still wouldn't dismiss them in July because inventory was down about the same amount going into June, and that segment still managed to eke out a year-over-year gain in market share in that month. Looking at incentives, incentive spending cooled somewhat after April's 26% year-over-year surge, although in dollar figures, incentive spending was still at record highs in May and June for those months. Even with a further pullback, price discounting and low interest rate offers are likely to keep overall incentive spending above year-ago levels in the third quarter. If demand does not start picking up by the fourth quarter, there will be enough inventory that manufacturers could start really goosing those incentives again if they want to go that route. Looking at the retail fleet split, the rest of the year for retail will be determined mostly by incentives and whether or not inventory levels can get up to par. Fleet is expected to remain a major drag for the rest of the year. Heavy incentives did work retail sales back to within 10% of year-ago levels in June, but that upward movement could stall a reverse in the third quarter because of the inventory picture. Horrendous year-over-year declines in fleet should start to improve in the third quarter and continue improving through the end of the year, due mostly to sparks of life in the commercial sector. Wrapping it up, It's containment of the virus and the overall state of the economy that will shape second half results. Some of the factors fine-tuning the second half results, but with uncertain ramifications. Incentives certainly pulled ahead some volume into the first half from the second half, while at the same time, a lot of consumers delayed their purchases from the first half into the second half, waiting to see more how if their situation becomes more certain. What we don't know is how much one might outweigh the other. Used vehicle prices, which started to die in the second quarter, showed some real strength in June, but defleeting by rental companies and delayed lease returns. And I threw in here that Cox Automotive estimates that at least 200,000 lease returns were deferred to the June-August period. Both of those issues could inflate inventory enough to weaken used vehicle pricing again. And then the influx of off-lease and rental units is also creating more competition for new vehicles in the form of creating more inventory for high quality, lower cost alternatives. A partial offset to that is the vast majority of off-lease customers tend to go into a new vehicle after they turn in their lease. With that, that ends this version of the 6-Minute Ward Seminars. Thank you for watching. To make sure you don't miss any further episodes and to check out content in our Summer Festival of Automotive, click on the link below, and we'll see you soon.